Afternoon all, welcome to the Trellidor results webinar. Terry Dennison, the CEO, will take us through the presentation, whereafter we will open the floor for any questions. You can pose a question while the presentation is ongoing by clicking on the Q&A button at the middle bottom of the screen, and we will handle all the questions then after the presentation. I will hand over now to Terry to take us through the results.
Thanks, Rian, and welcome to you all, and thanks for joining us this afternoon to receive Trellidor half-year results. And just a special welcome to Damien Judge, our new CFO, who's here with us today. Moving on to our salient points, the weak economy continued through half one, as it did in half two the previous year. And in this environment, headline earnings per share comes in at 29.8 cents, which is down 15% on the corresponding period. We've declared an interim dividend, as we normally do, of 9.1 cents, which will be paid according to the program in the results release. EBITDA came in at 56 million, and ROIC remains healthy at 20% on a rolling 12-month basis. I mentioned Damien, our new group CFO. He was appointed effective 1 March 2019 as an additional resource to the group to increase our capacity for efficient and effective implementation of group strategies. Taylor product sales through the Trellidor franchise channel are up 150% against the corresponding period, so that strategy is panning out nicely. In the Trellidor factory itself, we've implemented a factory efficiency project, which I mentioned in the previous results presentations and releases, and that went live in early August 2018. And the cost savings achieved through the period were ahead of target and ongoing, so very pleasing. Our SR3 project, which was the newly designed Trellidor retractable gate specifically for the London Underground, our first installations are complete, and we are hopeful of further traction in that project as more stations come online. In the Taylor business, a new external roller blind range, drop blind range was launched recently, last week in fact, in March 2019. The first sales are starting to come in on that range. And we've commenced the implementation of the Trellidor factory management system into the Taylor factory in Taylor to help us drive efficiencies at the Taylor plant. In terms of our growth strategies, we have 4 main focus points, being acquisitive growth, diversifying our product range and adding new products, international, but with a focus primarily on Africa, and then looking in a geographic expansion base, particularly for the Taylor business at this stage, using group synergies such as the Trellidor franchise model. In terms of a group overview, I've seen from the list, many of you know the group. The group does consist of 2 main operating segments, being Trellidor and Taylor. Trellidor is the owner and operator of the well-known Trellidor brand and manufactures and distributes custom-made barrier security products through a dedicated franchise network in South Africa and Africa. There's a further presence in Israel and the UK, and we have an owned subsidiary in Ghana. Taylor consists of 2 main operations. It's a manufacturer and a distributor of a wide range of quality blinds and security shutters. Business is concentrated in the Western Cape, and there's a limited presence in Gauteng and the rest of South Africa. The second part of Taylor, NMC, distributes and imported decorative mouldings through branches in Johannesburg, Durban and Cape Town. Our new external roller blind or drop blind that was launched in March 2019. It's just there for a pic for you to see. Certainly a popular product set in the summer months, so we're going to be well placed for spring come September. In our group financial overview, revenue is down 4% in the weak economy. Gross profit down 6%, and obviously volumes have an impact there. We achieved EBITDA of 56 million, and headline earnings per share, as I mentioned earlier, is down 15%. What is more pleasing in the environment that we're operating in is our gross margin was maintained at 45%, which is down from 45.6% at half year, and EBITDA margin sits at 19.5%, so still healthy. So the first half of the year reflects the continued tough economy, and in particular in the Western Cape on a relative basis. The geographic strategy to spread the Taylor presence throughout South Africa is certainly reinforced to mitigate concentration in any one market. EBITDA was under pressure with the lower margins and of course the inflation impact on costs and our ever fluctuating rand-dollar relationship. This has been mitigated in particular by the efficiency project which was launched in the Trellidor factory or implemented in the Trellidor factory in August, and tight cost control. Our future strategies include implementing group purchasing opportunities at Taylor and the aforementioned Trellidor manufacturing systems in the Taylor plant. The balance sheet itself remains healthy, and to point out, debt equity ratio at 39%. Our net working capital is at similar levels to half year 2018, but up from full year, so from the June full year results of 2018, mainly driven by increased inventory. Increased inventory primarily brought about by reduced demand over the last quarter of 2018 calendar year, which is our traditional busy season leading up to factory shutdown in December, and volumes were lower than anticipated, leading to a lower offtake of inventory and therefore higher inventory on hand. We have a targeted reduction in inventory through half two, and that's well in action at the moment. In terms of capital allocation, capital expenditure of 8.2 million in the period, primarily driven by the efficiency project at Trellidor, which is now fully implemented. Debt servicing, we paid down 6 odd million rand on our interest-bearing debt and returned some cash to shareholders, being the final dividend paid in October of 17.5 million, and further share buybacks post final results release of 643,000 shares, which are now cancelled. Moving on to the segments for Trellidor. Revenue is slightly down for the period by 1.5% to 172 million rand. Our international sales grew by 9%, really driven by excellent growth in the UK, and international is now 18% of the revenue pie at the Trellidor segment. Africa was disappointingly down for the 6-month period, driven primarily by our neighbouring countries, Namibia, Botswana, and Swaziland in particular, who also seem to be impacted by the weak economic conditions that is going around. The rest of Africa, though, did grow, and in some cases quite strongly. So we are expecting and anticipating improving conditions in Africa through the rest of the year. But geographically, the market remains well spread. In terms of products, on the Trellidor segment, we've got a well-diversified quality product range, which spans income groups, mitigating the current weak middle-class disposable income situation. In terms of trading margin at Trellidor, I think in the conditions that we're in, it's an excellent result to have an improved margin through the period, despite the muted sales. And this is primarily driven by the efficiency project, which I've mentioned several times already, despite the early implementation costs, which are also in the revenue numbers for the 6-month period. And looking forward, those savings will continue and accelerate in half two. Moving on to the Taylor segment. On our sales analysis, Taylor remains heavily concentrated in the main centres, with the Western Cape element of that being at around 2/3, 66-odd%. Taylor had a 7% decline in revenue to 114 million in the period, but notably the Johannesburg branch was flat year on year, so most of the decline driven out of the Western Cape area. We're pushing the geographic spread of turnover for Taylor through the Trellidor franchise model. This is gathering momentum, and for the 6-month period, yielded north of 150% growth against the corresponding period. In terms of products, Taylor has a well-diversified range, focused on quality products, being the blinds and security shutters, as well as the mouldings. I've already mentioned the launch of a new product being the external drop blinds in March. Trading margin at Taylor was under more pressure due to the lower volumes, mainly an under-recovery in wages and semi-variables, but also impact of rand-dollar on input material costs, only partially mitigated by selling price increases. Looking forward to mitigate the margin pressure, the group purchasing model is looking at opportunities of reducing the cost of certain of the key inputs in Taylor products, and that's currently being implemented. We will see the benefits of that in the following months, less so in half two, but more so going through into FY 20. It does take a bit of time for those savings to work through the inventory system. And we further to that are implementing the Trellidor factory management system into the factory, which will help us further drive efficiencies. In terms of prospects, the weak economy continues. We certainly don't see in the 6-month period any improvements in the economy, and we do of course have the elections looming in early May, which will also have an impact, we believe, on helping keep demand weak for half two of the year. We are, however, anticipating better conditions in Africa, and our UK projects that we're working on at the moment have continued momentum through the rest of the year. So our focus in that environment remains on margin protection and improvement, and of course managing our costs as tightly as we can. And as I've already mentioned, the procurement projects driving down input costs at Taylor in particular. The efficiency project at the Trellidor factory continues, and we will see, as I said, increased savings in the second half of the year attributable to that project. The Taylor products moved through the Trellidor franchise continues to gather momentum, and we look forward to that helping our geographic spread strategy for the Taylor business. In terms of people capacity, our new CFO is an investment in additional capacity, which again is help us speed up and implement the strategies that we have in mind. In the current share price environment that we're sitting, the board sees the business as undervalued, and any excess cash that is available will be applied to a share buyback program in the second half of the year. So that leaves the group in a position where we are more streamlined, with nice efficiency at the moment, and we're very well positioned to take advantage of any improving market conditions that might come to us in the future. The next few slides are additional information for you, so I'm not going to go through them in detail. We have a summarized cash flow slide. I think all that needs to be said there is that the cash generation remains strong despite the tough economy. And in terms of cash generation in the half year, the cash generation is comparable to half one 18. Then we've given you a group summarized balance sheet, which I think all that needs to be said is that it remains in a healthy position, and debt equity is improving as we pay down our interest-bearing debt. So thank you, and any questions?
Yeah, thanks very much, Terry. So we'll open the floor now for questions. So again, look at the middle bottom of your screen. There will be a Q&A function there, and you can post your questions to Terry and David. So the first question that we've got is from Skype. The question is, what is the anticipated impact in terms of revenue of the new external blinds on the channel business? And do you see that as being a big market or a big shift in terms of revenue?
Yeah, certainly we do see it as boosting revenue. It's an additional product stream. It's not replacing any of the existing products, and it's not going to be cannibalizing any of the existing products. So it's a totally new opportunity for the business. The momentum will start off slowly as we implement and launch and train through the sales networks in Taylor. So for the second half of the year, which there are 3 months essentially remaining for that product, there won't be a large impact for half 2. But looking forward into the future financial years, we are seeing growing momentum for that product. And as I said, it's a very popular product set, certainly through the summer months, which we well placed to achieve, as I say, come spring, around about September onwards, which we're expecting strong demand on that product.
Yeah. So the next question is from Johannes Himon. With regards to the London Underground, so you've mentioned previously there will be the product has been developed and has now been implemented, certain of the stations, but in terms of turnover, what could that affect in totality? How big do you think that project can be?
The first phase of the project, which, as I said, is now complete, products have been installed, was I'm sure London Underground won't mind me saying, but from sales ex-factory, we were talking about 13 million rand. And the second phase that's going to come through as soon as the station starts to finish is really dependent on the needs that we see. But we're anticipating at least 4 times that over the next 2-year period. These stations are taking a while to come online, and we have to wait until the station is almost complete until we can design, manufacture, and install product.
Okay. Right, so any further questions from the audience? Let's maybe give another minute, just any questions that anybody wants to raise. So again, As I said, please just type in your question at the Q&A function at the bottom of the screen, and we can answer that live. Okay, seeing there's no further questions, this concludes the webinar. Thanks very much for your time, and see you again. Thank you.
Thank you.